the dividing line is unconditional right. If it is unconditional, financial asset. And if it is not unconditional, it is license that I don't know how much I will get. It is very easy. So probably you have not, this 7-8 days, this kind of easy standard you have not gone through. The easiest standard, the easiest, I feel. And I'm sure you will also feel after once you go back to your home and read the entire text. Without reading text, you cannot feel it's easy. But when you read the text now, in 30th March 2016, almost in all standard, there are some or here and there changes. And the NSA website, whatever PDF is there now, those changes are not incorporated. So you can convert it into Word and incorporate those changes. Here, not major changes, here and there some changes are there. Now, a financial asset, the operator has an unconditional right to receive cash or financial asset from the grantor, from the government. An unconditional right also exists when grantor guarantees, बोला तुमको अभी इतना पैसा दिया लेकिन तुमको इतना रुपए तक का गारंटी देता है, तो मेरा जितना तक का गारंटी दिया मेरा अनकंडीशनल है. गवर्नमेंट बोलता है इतना देगा ना, इतना मिनिमम गारंटी देगा, तो जितना मिनिमम देगा वो मेरा अनकंडीशनल राइट है. Agreeing to pay specified or determinable amount and shortfall if any, that also government will pay. That is my financial asset. Now coming to other, an intangible is recognized to the extent operator receive a right to charge users of the public service when the operator is paid for the service partly by financial asset, partly by the license to charge. The two components of the consideration must be recognized separately. So, I've already crossed my time. I need to be very quick. So, there can be both financial asset as well as intangible asset. But at least, beyond that, there cannot be. I mean, it has to be either financial asset or, as I said, consideration sometimes may come in from asset also. They are transferred from asset. So then it can be PPE also. Now, say grantor pays a fixed amount per annum. What is this? Huh? All agree? Why? Because it may be wrong also. It may be wrong also. Amount is final. Unconditional. Yes. Grantor pays a variable amount depending upon the usage. It is variable. The amount is not fixed. It is not unconditional. So that's why intangible. Grantor pays a fixed sum plus variable charge depending on the usage. Financial and both. So in this case, you can account. You may need to account for both also. Financial as well as intangible. Operator collects revenue from user at the rate fixed by the operator. Fixed rate fixed by the operator or grantor. It is one and same because ultimately the grantor will control. If grantor does not control the price, it is not service concession arrangement.
Fixed by operator.
It is. Let us take it as fixed by the grantor. Intangible because variable. Operator collects revenue from the users. And grantor has given guarantee for minimum revenue. Till minimum revenue. Financial. Otherwise? Great. Operator collects revenue from users. Grantor fixes revenue in a manner that it is highly probable. Operator shall get minimum return. However, there is no guarantee. But he is fixed now. Probability is there. We talked about probability. More than 50% chance.
But there is no guarantee.
But probable.
Probability to enable.
Any other answer? No guarantee. No unconditional. It has to be unconditional. So even if it is 90% probability, virtual certain, then also we will not agree because we will be लकीर का फकीर. हमने पढ़ा है उसमें unconditional बोलने का है, unconditional नहीं है. UN का है उसमें. एक कंडीशन है, 10% का कंडीशन है. इसीलिए हम लोग इंटेंजिबल करेंगे और कुछ नहीं करेंगे. It has to be unconditional. Service concession arrangement. EC is a company, EC to buy 100% output at a specified per unit price. The price is subject to change due to CPI, Consumer Price Inflation Index. Adjustment. The operator has no demand risk. since issue to buy 100% output, one view, here it says that solar energy company, where it says that the output will be 100% sold to the government. Whether it is a financial, it will be financial asset or it will be a financial asset or it is intangible. Both views can be there. It says that both views can be there. But what will be your view? What will be your view? It's one view says that income is secured because it will be sold at a fixed price, and unconditional because of low credit risk, because some signs every day. Suraj to roz ugega na. That's why it is financial. The other says no, intangible. Your view, this side. This side. Both sides intangible. So I have no choice. I'll go with the Janta. Intangible. Our view, why will say? It says that the sun will shine every day. 1% chance is there it will be rain. As I said, even if it is 90% chance it is sun will shine a 90% day, 1% it will not shine, that day I will lose money. So it's an intangible. It is not a financial asset. TAL Limited enters a service concession arrangement to construct, operate and maintain a new highway. TAL Limited is permitted to collect 6% return on agreed infrastructure. Once the operator has achieved the stated return of 6% arrangement, the arrangement comes to an end. Financial. Other, everybody is not very confident. Financial? Financial? Sure?
Yes.
Why?
Because the amount is fixed. It will be given in a period, but it is fixed that, and at the point of time he reaches, he will stop. So it isn't guaranteed कि आप जब तक रिसीव नहीं करोगे आपके पास टाइम है कि
वो हमारा जमीन जो है कोई भूकंप आया खत्म हो गया तो
अनफोर्सीन लॉसेस तो हर चीज से एसोसिएटेड होता है.
तो तभी तो हमको इंटेंजिबल करने का. Since there are many clues missing, कितना साल का है क्या है, so we can give a benefit of doubt to her also, but it can be apparently it seems financial because guarantee, it says that the guarantee level you reach it will complete, so you will get that minimum amount, but then the other question, the other items are not there, so we cannot be very confidently say that what should be there. Now, service concession arrangement. Maintain a new highway for 15 years. The construction of the new highway should be completed by 3 years. From 4 to 15 years, grantor will pay operator CU 200 per year. Current CU 200 financial. Because there is no hunky panky. It is unconditional. Financial. Now, initial measurement. The operator acts as a service provider. Fine. Everybody agrees. Typical service include construction. What we talked about bid, what we talked about finance, what we talked about operate, what we talked about maintenance. So construction, upgrade and operation. It can be upgrade also. Instead of construction, they gave us the old building, say that you upgrade it, so we invested there. Need to recognize and measure revenue in accordance with AS 11, India's 11 or India's 18. If it is construction part, 11 or otherwise 18. Consideration received, fair value. Consideration has to be fair value only. India's 38 says that it has to be at cost, but it can be revalued also, but revalued in a very few limited circumstances when the market exists. So generally, as for India, intangible cannot be fair value. It has to be cost less amortized. Whatever we are amortizing, so that should be reduced. As said, fair value of construction, India's one fair value initially, and then India's one others say there are 3 methods. What is the India's one says? Asset, amortize. Oh, you did not read it. Amortization, OCI, and period. Either. So that we will judge. That we will, when we will read 109, we will discuss about that. That is followed by certain company. A company, construction of part 1, financial asset, recognized by company in exchange for construction of service provided is recognized as fair value. The fair value consideration received Receivable for the construction service is calculated by including markup. So how fair value cost plus markup 10%, 15%, 20% estimated to reflect the margin. Markup is 10%. The second is they are talking about the effective interest rate also. Amortization. Amortization of intangible has to be done. Begins only when the construction right is available for use. Say it says that 2 years for construction and use will be from 4th year. So when your amortization will start? From the date user right. User is from 4th year. So 3rd year, no amortization. First, second, third, no amortization. From 4th, probably I am disturbing my dear friend. My apology, friend. So from 4th year, amortization will start till the time of use. So say 5 years use. So the entire intangible has to be amortized in 5 years. In a rational, systematic, but whatever rational system we adopt in a consistent manner. Example, company A construct a road. First 3 years there is no collection, right? The company start amortizing intangible from 4th year till 20th year. Now, electricity supply. Operator of the electricity supply service concession arrangement, 10% margin. Overall work to be a separate revenue generating activity. Contracts is executed. No. Second line is very important. Here, now another India says pieced into. Expected cost of overall. Now they are saying that you need to overall also. For that, you will get 1,000 rupees value. 1,000 rupees cost will be there, and you will get a 10% markup. Now, that since this will be another contract or what? It says that it is an executory contract, and it has to be accounted for separately. And then because on 1,000 rupees cost, you will get 1,100 rupees. So 100 rupees is a margin. It is not the part of the maintenance of the original contract. Friends, now there are two examples. I have overspent my time. Intangible asset model and fixed asset model. Since I will be giving this PPT to you, there are 5-6 slides for each of these two examples. I will request all of you that go through that. I will not just read. I just, too many times further I will take. I just rush through that, but then I will not elaborate. Unless and until you go through those 5 slides each for how you will account for intangible model, intangible asset model, and how you will account for financial asset model, probably you will not understand. So you need to go through those beautiful slides. Very small letters because it is bulky. Construction, first year 500, second year 500 cost. Operation 3 to 8 years. So if it is intangible, the amortization will be from 3 years only. But we are talking intangible asset model. So the amortization will be only from 3 years to 10 years. And road surfacing is 100. Now this road surfacing is not a separate contract. That means this is my liability. So I need to account for 100 rupees from today. The present value of 100 rupees start from 3rd year, because first and second year is construction. From 3rd year, I will start providing for on a present value basis using effective interest rate for 100 rupees. So that at the fag end, when on 8th year, the 100 rupees is required, it will be available for me. I will not have to fork out from my pocket, but that hidden reserve will be there, or the reserve for 100 rupees will be there. So that is there. Now it is calculated how fair value is this. We spent only 500 rupees for 2 years, 1,000 rupees is my cost, but 10% markup. So the fair value where I will account for my intangible asset will be 1,050. Plus, as I said, borrowing cost only in case of the intangible will be capitalized. In case of financial asset, it is not capitalized. So 34 rupees is the borrowing cost. So that is also capitalized. So 1,084 is fair value, and it will be accounted for. Borrowing cost only in case of intangible, no in case of the financial asset. So now that is the calculation that will go. Intangible is over. Now financial asset. In case of financial asset, it is like intangible, but what is the difference? Effective interest rate, interest has to be charged And number 2, no borrowing cost will be included, it will be expensed. Number 3, welcome to Chairman. No borrowing cost to be capitalized, so that is the difference. You see. But here the construction service, operation service will be accounted for 18, construction service 11, road surfacing. If it is not a separate contract, then 37. As per 37, we have to provide a present value or with effective interest rate. Effective interest rate they have already given. They are very kind. Then again, this is calculation, and thank you. Thank you very much.
We are thankful to the learned speaker, C.A. Subodh Kumar Agarwal, for the wonderful speech along with the PowerPoint presentation and good question answers with the flow charts also. We all have enriched our knowledge.
I'm sure there should not be any, if I'm effective, there should be no question. If I'm ineffective, then I should come back again.
So you told that now, if I will explain that there will be no query and the topic will become more easier. So don't worry, 50% of them could give a speech on accounting standard 11. They can think to give a speech on this topic. And at 7.30 all are here, then it shows that all of you are well satisfied with the speech of Subodh Kumar Agarwal ji. You can also hear C.A. Subodh Kumar Agarwal tomorrow at Hotel HHI, because tomorrow is one program in Hotel HHI, that is fraud detections and internal control. Internal financial control and fraud detections. So you can also participate tomorrow at Hotel HHI, wherein P. Ramesh ji along with the Subodh Kumar Agarwal will be there. For giving a token of honor to C.A. Subodh Kumar Agarwal, I would request C.A. Sagarmal Gupta ji, please come up on the dais and offer a memento to C.A. Subodh Kumar Agarwal ji. I would request the learned speaker, C.A. Arif Ahmed ji, please come up on the dais and take your chair. Please give a big round of applause for welcoming C.A. Subodh Kumar Agarwal. Chairman ARC, C.A. Anirban Datta ji, I would request C.A. Anirban Datta ji, please come up on the dais and offer a welcome bouquet to the great speaker, C.A. Arif Ahmed ji. Mr. Arif Ahmed is a fellow member of the Institute and MBA also. He is a BS 7799 lit auditors. Chairman sir, take your chair. From British Standard Institute, the focus area of Mr. Ahmed. So nice of Vice President C. Subodh Kumar Agarwal, my elder brother. कोई सोच ना ले, पता नहीं कैसे कैसे. That's why I told that he's just like
accounting जो करता करने दो, standard को छोड़ो.
The person who are doing accounting are not here. The person who are not doing accounting, they are true and transparent chartered accountant. They are not worried with the Kaladhan and all. They are sitting over here only. Tomorrow the session is start from 10 and it is at HHI. Here it is 2:30.
No. Tomorrow
The accounting standard is same. It will be goes.
Tomorrow we will assemble here at 4:30. From 4:30 we have rescheduled the.
Accounting standard will be goes like that every day. And, yeah, and HHI
It was supposed to be 2:30 to 6:30, now it is changed.
Yes.
because the another program will simultaneously go to a Hotel HHI from 10 to 4:30 to 5 like that.
HHI is 10.
10.
10 to 4 there and from 4:30 onwards here.
So you can attend both the program. This is the series of what you are learning regularly since last couple of days, and that is a different topic on fraud detections. So Mr. Arif Ahmed ji, he is specialized in risk profiling for information security purpose and also for Basel II norms for banking applications. He has worked in India and abroad in many professional assignments in his area of specialization. Many banks and IT dependent units have made use of his expertise. Even we have also used his expertise. When I did my DISA course, he was a faculty. Mr. Ahmed is a regular speaker in the area of his expertise in India and abroad because he is not teaching DISA, he is teaching CISA also. Very few speakers on that topic. He is a guest faculty at several management institutes in India, including XLRI, Jamshedpur. Mr. Ahmed is a great partner in Arif Ahmed and Associate, Chartered Accountant, and Director in South Asian Management Technology Private Limited. So I will request Arif ji, please start your deliberation on Int AS 18. Over to you, sir.
Thank you. Good evening. Good evening, ladies and gentlemen. Am I audible? Yes. With the mic or without the mic?
Without the mic.
Yeah, looks like it's without the mic. Right. As always, I'm grateful to the institute here for inviting me to speak on this particular subject. I'm generally not a speaker on this subject. I focus on the other areas. But once in a while when the institute calls in, it's a good time to rehash a topic which I've been otherwise neglecting. And while discussing this topic, in between if I end up saying IFRS, please pardon me, because that's what I train around the world for at least 8 or 10 times. So I won't say old habits die hard, but new habits die hard in this case. What I'm going to do is I'm going to take you through this revenue. I'm not going to teach in this 18, I'm going to discuss in this 18 with all of you. Because I believe this is, Subodh has just left, otherwise I would have picked up a fight with him in terms of finding out which is an easier standard, this one or this one. I strongly believe that this one is perhaps the easiest standard as long as you are clear on few concepts, right? And I strongly believe that as far as the profession is concerned, it is more important to know where the knowledge is than to know what it is. Because when I'm going to apply the knowledge, I'm very sure going back to the standard and will look into that and take the call. So that would be my focus when we will go through this together. What the broad scopes are, again these are essentially for discussion and I presume that this will be handed over to you. So at times when a speaker is not there, this would perhaps add to the verbosity of the presentation. Regarding the major important areas, the focus should be on the moment of recognition, amount to be recognized and disclosure requirements. They are the two critical areas. As far as the disclosure requirement is concerned, I can solve your disclosure requirement across all the Ind-AS by simply stating that the moot point of Ind-AS, the basic theme is when in doubt, disclose. Right, the measurement of revenue. This standard draws heavily from the publication of the technical committee of the institute. There's a wonderful publication called the Educational Resource on this standard. I would strongly suggest that you kindly download it. I never told it earlier because we would have left by the time. With everything I'm doing here is governed by that particular standard. So if you look into that material, it's wonderful. So what it does, it talks about, here is the critical points. I'm very sure from the last you may not be able to see that, right? But it speaks about the revenue shall be measured at the fair value of the consideration received or receivable. Now hold on. Fair value of the consideration received or receivable. Sounds funny, right? So I pay you something and I still say that the fair value of that could be a little different, right? Just if the mic was on, suddenly you can hear through that. So the problem would naturally be a lot easier if the payment is in cash or cash equivalents. With a fair value of cash or cash equivalents is that amount. So where would the challenge be? The challenge would come in a different aspect. When it says here that, let's look at this first, fair value of the consideration received or receivable, taking into account any trade discount and volume rebate allowed by the entity. That's clear to all of us. So I am going on a net basis there. In terms of the recognition part, when do I recognize it? That's the critical part. You see, in terms of our understanding of the standard, it is not really critical. The measurement will not become very critical in most of the cases. In most of the cases, the measurement will be contractual. The fair value assessment of that would have a limited scope, and that scope would be on few cases which we'll just discuss. The real challenge would come in identifying the point when the revenue is to be recognized. And broadly in that case, from that aspect, if you look into this area, when it is probable that the economic benefits associated with the transaction will flow of the entity. Probable, not necessarily certain. I'm not very sure whether there is a specific angle in which this works.
So when the value will be contractual, then in that case the fair value concept will not come.
It can still be there. It can still be there. That's why the fair valuation comes around. Because maybe the contractual value hides not only the cost of the risk and reward transfer, but something else with it. So only in such cases I need to segregate them. That's the challenge. Otherwise there's no problem there. So what we look into there here is, as we say, in case there's an uncertainty that arises about the collectibility, that we will look into a separate process. So what we do here, it says the uncollectible amount or the amount in respect of which recovery has ceased to be probable is recognized as an expense. So it's clear, the provision part of it is being clear. So if you have got the revenue, wonderful, I know, I'll do the fair value of the consideration that I will take over. And the second part is that having recognized it as a revenue, if it was still collectible, and there's a doubt in terms of its collectibility, the extent of which is in doubt, I shall charge it as an expense. Right. That's very clear. Now, a little complication could arise because what may happen, the revenue receivable may assume the character of a financial asset. That's critical for us to identify. The moment it leaves the ambit of revenue and becomes a financial asset, this standard is no longer applicable. Then any future doubt in terms of the collectibility will be governed by the financial instrument standard. And that's where the expected credit loss and other issues would come around.
At that time, that trade receivable and bad debt.
That's right. So here you need to understand there's a slight opportunity. I mean, though I'm not very sure how many of the windows you will get, because the moment you create the word receivable, it's most likely it will move into 109. It will not remain in here. So the moment it moves into 109, you can't refer back to this. Right? So at that point, the expected credit loss will become applicable. So as we said, if the consideration is form of cash or cash equivalent, amount of revenue is the amount of cash or cash equivalent received or receivable. What happens if the inflow of cash equivalent may come in a certain way, if that particular inflow, how do I find out the fair value? If the fair value of the consideration is less than the nominal amount of cash received or receivable. Fair value of the consideration, the consideration need not necessarily be cash or cash equivalent. So if there is something else which is coming to me as a consideration, then this issue would come around. And what we do there, for example, an arrangement effectively constitute a financing transaction. The only challenge would come in here. A normal credit period is 1 month. I have provided a 6-month credit period. So would I possibly extend the same price? No. So you see, here is a receivable in a cash or cash equivalent. But the cash or cash equivalent is not the fair value of the product I am selling. It constitutes the fair value of the product plus a financing cost. So that's what the segregation would come around. I need to segregate between the revenue and my interest. Just the reverse of what we were doing in case of a borrowing cost. Right? We're segregating them. That's exactly what I'm doing in terms of my revenue. And what would I do? How do I find out that imputed rate? Is usually by reference to the prevailing rate of a similar instrument or whatever I've issued or I'm receiving it, the way I'm getting it, or I would like to say that if a normal cost is a 1-month credit, what is the normal price for that particular transaction with a 1-month credit? And then I compare it with my price, and that gap I will use it as an effective interest rate method over that period. I'll take that out. And if there is a very clear terms, then I can find out the rate. If I know the financing rate generally which is applicable on this, in that case, for example, in a car, I know the financing rate. There's a market in which if I go and borrow money from a bank and to get a car, and in other circumstances, the vendor himself or herself is telling me that pay me after 6 months at this money. So therein I have a proxy. I can go to the proxy and use that proxy as an imputed interest rate there.
That means in that case the revenue will come down.
No, the revenue, yeah, fair enough. If I'm talking about Index 18, yes, the revenue under the purview of Index 18 will come down, but you're going to earn somewhere else. The interest cost is coming to you. So cash flow remains the same. Right? So what happens actually is, the focus, to be very honest, is on my operating profit. The reason I fight so much on these nitty-gritties is essentially to distinguish that whether I am earning profit from my main line of operation or am I making money from somewhere else.
That imputed cost will be given by the customer.
Naturally. If I've given him on a 6-month credit, they come around to me. So you would find in US during the crisis period, the profit that a large number of companies earned was not based on their operating profit, but it was the financing that they earned for. Then they couldn't sell the car, they couldn't sell the house at the fair price. So they sold it almost at the cost, gave them extended credit, and made a little margin on that money. So unless you look at the document, unless I split them, that analysis is not coming through. If I'm looking at the net profit, it remains same. It remains the same.
But in a lot of companies, what happens, even with the delayed payment, they do not earn the imputed rate of interest.
That's right.
Yeah.
That's what the Index 18 is telling us to look into. That's what becomes our point of contention. That I'm going to tell you, you can't take this to your revenue. This is your other income. You split it into two. Oops. And the challenge comes around if there's a swap. Right? This is very interesting and very common in certain industries. We don't come across them very easily in India, but across the world you'll see it. In India also, I'm very sure it will come through.
Barter.
Almost like that. Now the barter naturally does not exist in that form. So how does it exist now? What may happen that I have this usually would happen in a product which are a generic product, which are not very specific branded product. So for example, if I have to supply liquid petroleum to somebody in Assam, and I am based in Mumbai. I have a client in Assam, and there's an Assam company who has a client in Mumbai. So what we do, I ask the Assam company to supply to my client in Assam, and instead I supply to the Mumbai client of the Assam company. Right? So this is what I'm talking about as the swap. Pardon me, I have a bad throat. I came back to town at about 4 o'clock. I made a call to Nitesh, trying to sound as down as possible to get his, mercy and sympathy. Didn't work. Right. So what happens in case of the goods or service that are being exchanged are similar in nature, then this exchange is not regarded as a transaction. Alright, so take this company of a petroleum supply. So if I have delivered for the company which is based in Assam, I am exchanging between these two companies, the Assam company and the Mumbai company. This exchange is not a revenue transaction. Whatever I have earned is my revenue, whatever the Assam company has earned is their revenue. But if it is dissimilar, then it happens. Any guess which is where you have the maximum use of this? We have all seen it, but we astounded, we get at times surprised, but we don't recognize this happening. Not a bad idea. But I'm not very sure whether they apply accounting standard to that. In your media, Times of India carrying an advertisement of, say, the Anand Bazaar. Right? Some of you may remember Statesman and Bartaman used to carry the advertisement of each other. Right? The network, the media network, Star Sports carrying an advertisement of a program of a 10 and 10 carrying of a Star Sports. This is a very critical application of this standard. So if you're handling media, if you're talking about advertisement spaces, outdoor media spaces, these are a very, very common application that we see here. But otherwise, the generic products are not much there. Right? And therein the challenge comes because a 8 o'clock slot is not the same product as a 6 o'clock slot. Because it says that in case they are dissimilar, the exchange is regarded as a transaction which generates revenue. So in that case, Star Sports have sold 10 minutes, 8 o'clock slot to 10 sports, and 10 sports have sold 10 minutes, 6 o'clock slot to Star Sports. So these are two distinct transactions between these happening because there are variation in the price. But if there are no variation in the price, this intercompany transaction exchange is not recorded as an independent event.
I'm just imagining what the GST people will say. I mean, this is going to be very, very complicated.
Well, as far as I am concerned, I live in a wonderful, peaceful world. I don't understand taxation. Right? I just don't understand. You won't find a more stupid chartered accountant as far as taxation is concerned. My income tax return is filled up by somebody else. Right? But of course, outside the room, I will not acknowledge that. That is what, since you raised the issue, that is where accounting died. Because accounting as a profession was not taxation, was not corporate law. But unfortunately, all of us have been trained to subordinate accounting to taxation and to corporate laws. That's why we ended up no longer being an accountant and ended up being bookkeepers. If you go internationally and look at the accountants, there's pure accountants. Somebody else is taking law, somebody else is talking about corporate law. That's why we are not seeing good accountants coming out from us internationally. That was not a complaint, that was a lamentation. Now, let's look at the key concepts. Let's focus on some of the areas to make clear. Let's take income. To understand what is coming in revenue, let's talk about income. So one part could be sale of goods, rendering of services, or use of assets, which would yield interest, royalty, or dividend. That's one way I can earn. Construction contract, a separate standard altogether now. Other incomes and gains, for which I have a separate standard, like lease, like insurance, like financial instrument, biological assets, dividends. I have separate standards for them. So right now, when I'm talking about, first part is to understand, only when it is here, sale of goods, rendering of services, use of assets, that I'll be using as it. otherwise not. And this is the revenue I am going to talk about. Others I have got separate standards, I am not bothered about it. Coming in here, in terms of my revenue part of it, I am breaking them up now. Sale of goods, rendering of services, and use of assets by others. Sale of goods, what is the critical point? Transfer of risks and rewards. Now that is always a challenge to find out at what point of time the risk and reward has been transferred. What I do, I'm not suggesting that's the best way of doing it, but it's a good thumb rule. I ask myself that if this product was insured at the point of accident, who would have gotten the premium? Who would have picked up the claim? That gives me the idea who's the owner. Because from the insurance viewpoint, unless you have an insurable interest, you can't insure it. And the fact that you have an insurable interest means you are the one who's exposed to the risk and reward. So it's, through a little circuitous way, I apply this tool. I'm not saying this is 100% proof, but I think it works pretty well.
But insurance is also endorsed.
Pardon?
It is endorsed also.
That's deciding on at the choice of the claimant says instead of paying me, pay the other person.
When you are exporting the goods,
Right.
though it is a CIF contract, it's still what happens? Insurance you are taking, but the insurance claim is settled to the buyer.
That's what I'm saying. I am the one. It's at my instruction it is happening.
So at the time when you are dispensing the documents, you put your endorsement there,
That-
and then good system.
So I have the insure. So here the question I would ask you, following your example only, that when I took the insurance, did I take the insurance essentially as an agent, as a part of the contract? Then only the other person, just a scenario, the other person may not be in a position to do that. So he wants them insured. He asked me to do the insurance in his favor. So at that point of time, I acted as his agent as far as that insurance is concerned.
Can I add here?
By all means.
This is what actually we do in export import. Why this happens is the insurance is taken by the seller.
That's right.
But the claims are payable to the buyer if the insurable incident happens. That is because as soon as the goods cross the ship's rail, the property in goods, risk and reward are transferred to the buyer. It becomes the buyer's property as soon as the goods cross the ship's rail. That is why it is like
And
that.
now isn't that not also governed by whether it's a CIF or a FOB?
Yeah. No. As soon as the goods cross the ship's rail, whether it is CIF or FOB, it is the buyer's property.
Well, I'll accept that since you're working on that.
I'm working.
Yeah, since you're working on that, what I'll do is I look into the contract and
You're
see,
correct.
that to whom to where it rests.
There are other contracts also, DTU and DTC contracts are also.
No. As soon as it passes the ship's rail, because I handle export import in the bank. That's why we do it.
Right. Second part is again is a critical one. It says retain neither managerial involvement nor control. Isn't that interesting? That the risk and reward is transferred and I have not retained any control over that asset. Because if I have retained the control over the asset, the ownership is not absolute. The transfer is not absolute. So this is essentially a corroborating provision to check that whether the risk and reward has actually been transferred. I go back and say that do I have any control left over that, a managerial or some other control? That's a very interesting provision here. I can measure the revenue reliably. That holds for anything. The moment I go into accounting, until I can reliably measure it, I can't put it there. Probable economic benefit will flow to the entity. So in the case where I have not received the consideration already, it's probable that I will receive it. And cost incurred can be measured reliably. Because I have to abide by my revenue matching. So of this, I think the greatest challenging part is retain neither managerial involvement or control. Because if I have retained it, then the other person may be a beneficiary of the income which could be of some other right and not necessarily a transfer. Let us consider I'm author with John Wiley. Now John Wiley's copyright is an international copyright. Somebody in India says I'll come out with an Indian reprint. So they go to John Wiley to get the right. Now think over it. Have they bought over the right? No. John Wiley has merely given them an authority to reprint. So it will not get governed by this standard. When we say that it is not coming in here, does not mean it's not coming into accounting. It does not mean that it is not my income. It merely means it's not governed by Ind AS 18. It is governed by some other standard. So that's one area which I presume, particularly what Subodh emphasized a lot earlier in terms of my intangible assets. With at times in my intangible assets, I confer a limited right. I confer a right for certain period. Next 5 years reprinting right is yours. After 5 years the right comes back to me. So the risk and reward has not been transferred. So that earning will not come under Ind AS 18. Well, it could be my royalty earning, so it's not here, but it comes into the usage of other assets. Use of assets by others. Right? You see, I've broken them up. Sale of goods, rendering of services, or use of assets by others. So this one falls under my third category, use of asset by others.
Under AS 18.
Pardon?
But it will come under AS 18.
If these three conditions satisfied, it remains under Ind AS 18. Now, which paragraph of Ind AS 18? That is the contention. If it is rendering of services, again, revenue measured reliably, probable economic benefit, stage of completion, is incurred, cost incurred. We have discussed them in details earlier. Except for two areas which I would like to focus on. One is outcome not reliably estimable, with comments to the extent of expense. Or for other services, when between these two nothing is happening, that moves into my inventory. You see, interesting component here is to identify the economic benefit because all the risk and the terms of the service. Let me explain why this is critical. At times, some of us quite offensively claim that look at a doctor, he comes out of the surgery and even before informing how the patient is performing, outstretches his hand for the fees. Right? From the viewpoint of the standard, what's wrong? I appointed him. What was the appointment for? Appointment for was to conduct that surgery. It is not related to the outcome of it. So he's delivered it. The revenue is due. Why I'm taking this example is because often when we talk about a service, we do not define what service I am actually taking. The service may be a way to satisfy some of my needs, but the need satisfaction may not be the obligation of the service provider. I have taken power connection here. Having taken the power connection, we have set up the lights and the air conditioning. But the CES's obligation is not to ensure that the room is cold. Its obligation is to ensure to supply power at that contracted load. So at times, unless I understand this clear aspect, that what is it that I am buying? Have I hired a specific car, or have I hired an airport drop? Right? So as an accountant,